Today, we're talking about the neutral market regime. What's up, everybody? Chris here. I am the head systematic trader at Macro Ops. So let's talk about what is a market regime. Market regime is a way to categorize the market, organize it so that you can compare maybe a current condition to a previous condition. Unlike comparing, let's say, like a bull market with a previous bull market or a market crash with a previous market crash or something like that, because each one of those is a lot different. What we want to do is we want to organize price action and volatility as a way to narrow down how we categorize and compare each different market regime. And for that, I use an indicator called the SQN Indicator. It's a free indicator I made on Tradingview. Go get it. I put a link down below so you can just click on it, add it to your chart, and you can see, follow along, do it how I do it. So let me go over market regimes really quickly, because I did a video on the SQN Indicator like broadly about how I use it in a separate video. I'll put that link down below. But before we get going, hit that like button, please. Costs you nothing, helps me out a lot. While you're at it, subscribe to the channel. I'm putting out all these videos. We're covering market regimes, covering indicators, covering how I set up my systems and how I trade. On top of that, I do a weekly market overview so you know what's going to be happening the following week, not just what just happened, but what's going to happen, what we're looking at Macro Ops for the following week. Okay, back to business. I measure a market by direction. So it's bullish, bearish, neutral. And then I add volatility. So high volatility or low volatility. So bull volatile, bull quiet. Those are the two bullish directional regimes. We got the neutral regime. We have the bear quiet regime. And then we have the bear volatile regime. We're going to focus on the neutral regime today. Each regime has its own unique characteristics and own ways to trade it. In a trending market, like, you want to use a trending system. In a mean reverting market, you want to use a mean reverting system. In a highly volatile market, you want to really tone down your size. And then in like a really quiet market, you can have more size on your trades. Okay, so we're going to look at the S&P 500 for our example here. This is the largest traded product. Everything interacts, touches, feels, is involved, is affected. If the S&P gets sick, the entire market catches a cold. Is that how the saying goes? The S&P is the most traded asset out there. We've got ETFs, we've got levered ETFs, we've got futures, we've got mini and micro futures, we've got options on the exchange, we've got options on the ETFs. It's everything. It represents the top 500 biggest public companies traded in the largest stock market in the world, the United States. So on my chart, this is the S&P 500. You can see it goes back quite a bit. I'm trying to make it go back. It doesn't want to go back. This thing goes back to, like, I have data back to 1928, I believe. And then across the bottom, this is the SQN indicator that I talked about. Links in the notes down below. This is what it looks like on your chart. So each one of these colors represents a different market regime. So we've got bull volatile, which is the blue. The green is bull quiet. The yellow is the neutral. We've got red in here, which is bear quiet. And then we have the crimson, which you don't get to see very often. Bear volatile, the absolute craziest of them all. Yeah, I think you got to go back to 2000. Yeah, back to 2008 was the last time we had one of those. So they're extremely rare. When they do fire off, it's actually super important to know, because, if it actually happened, that actually represents a very significant market bottom. So I wrote some code, or a friend of mine wrote this code, and it represents, I think it's almost 100 years of data on the S&P 500. So we went out and we pulled the daily data and the SQN data for the S&P 500. And we organized each one of them in the corresponding market regimes: bear volatile, bear quiet, neutral, bull quiet, and bull volatile for the S&P 500, about 100 years of data. What we can see here clearly, the neutral market regime is definitely the most traded market regime for the S&P 500, closely followed by bull quiet. Bear quiet a little bit in there too, and bull volatile substantially higher than, remember when we went looking at for a bear volatile instance, it's just so rare. Of 100 years of data, only 246 have actually traded in bear volatile. So it's rare that you actually get to see it. But like I said, you can see the neutral and bull quiet account for well over half of all the data. Of all the days that it's traded, it is by far the most, those two combined. And that adds up, because by design, the S&P 500 only trades the top companies in the biggest stock market, in arguably the strongest economy in the world, ever since pretty much World War II, it's just gone straight up. Let me show you here. So this is the S&P 500 to about the date we're talking about, 1928, 1929. We had the Great Depression, big crash there. And then pretty much since 1942, it looks like it's just gone straight up. Yes, there have been drawdowns. Yes, there have been 10 years of a bear market. Yes, all those things are true. But since the bottom there in since World War II, this thing has gone from about $7 to $6,200. So when we see that the neutral and the bull quiet market regimes trade the most, those are the ones we want to focus on the most when we're talking about the S&P 500, because all the other times that it happens is far less significant. It certainly is significant when you're in the middle of it. But if we were to say, okay, where do I want to start working? What do I want to learn? Like, where do I want to put my focus on first? I start with neutral, then we move on to bull quiet, bull vol, the whole thing. So one other point about the S&P 500, why it is in that sideways or up direction, is the S&P 500 kicks out poor performers and brings in the stronger performers. So if there's a company that's not doing so good and there's another company that's really pushing them, they're going to get included in the S&P 500, and the company that's not doing as well, they're getting kicked out. So the index itself is always organizing itself. It's always re-indexing, re-optimizing for strength of a business, which is why it continues to drift higher. You know, if you compare this to maybe like a small cap stock index, Russell, anytime a stock starts to perform in the Russell, it actually gets taken out of the Russell. And that's why the Russell doesn't trade similarly to S&P 500. These are things you need to know. So what works well in a neutral market regime? Probably, like you could guess, buying dips, selling rips, mean reversion trading. Mean reversion trading is the thing that works. And it's kind of cool because mean reversion is like easier to trade. There's a higher win rate in mean reversion trading. Whether we're talking day trading mean reversion or swing trading mean reversion, it works in the neutral market regime quite well. Now, you can't just go out and say, oh, well, this is it. I'm just going to buy every dip and I'm going to sell every rip. There's big benefit to using a strategy. So in neutral regimes, there's actually big directional moves sometimes. You may have a market that has been going down for a week or two, only to see it spike up and have big multiple up days, convincing everybody that the new bull trend is on. But what often happens in the neutral market regime is it peters out, it fails, it stops, and it goes back into the mean reversion. So everybody got on board long, and now they got to sell, and it goes down, which causes the same thing to the downside. It convinces everybody that the market is about to crash or burn or go into recession or all those things, gets down there, stops, turns around, goes up. And so you're constantly getting these stop outs and reversals where everybody is getting on board with the idea that the new bull market's here, we're going to crash. And instead, we're just going to spend our time sideways. Again, look at how often this regime happens. It's the most common regime. So you're going to hurt the most people. So having a systematic approach to trade that keeps you from getting too excited when everybody else is drinking the FOMO. It keeps you focused on your position sizing, on your risk parameters, where you're taking profits. In a mean reversion market, you don't want to be trail stopping. You want to be taking profits at a profit target. So the neutral market regime is a little bit of a wily creature. It is the most traded market regime there is. And so you would imagine that it would hurt the most people. Now, the thing about using market regimes is not to be precise with them. They're not built for precision. These are lagging indicators. These are lagging tools. They're meant to tell you the environment that you're in. They're the conditions that you're in, what to expect. Like I say, it's the summer in Arizona. You don't expect a snowstorm. You expect a lot of heat. So you don't have to worry about everything else that could possibly be happening in the market. You can just focus on that market regime. What happens in this market regime that I'm trading? That's my focus. And so you go find previous times on the chart where you were in the neutral market regime. What was the price action that worked over here? Oh, look at it again. There it was. Neutral market regime. What was the price action that worked there? What's price action worked there? What's price action worked there? Go find out what worked in those market environments and apply that knowledge to, the current market that you're in. Right now on this chart, we are in a neutral market regime after selling off over 10% in the S&P 500 as of the time of this writing. You can see that we got our bull volatile top, which was in a previous video, I talked about that. We traded down through it. And then now we have this big, if I can bring it up, you can see we've had some multiple, so it's a 2% day, multiple 2% days down here after 2 weeks of selling, right? So we get down to the neutral regime, the most common regime, and everybody's convinced that this market is going to go to down here or something, right? And as soon as everybody's convinced that, what do? We rally up. We have big, strong up days. And what does that convince everybody? Oh, the market's bottoming. We're going to go higher. Or dead cat bounce, right? But what we know right now, this could change tomorrow, this could change whenever. What we know right now is that we are in the neutral market regime. So I'm going to expect, and you can see it, these tails here. We got a reversal, boom, 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 super strong, down, up, down, up. And you see these wicks, these big wicks. This is mean reversion trading. Goes up and then comes back, goes down and comes back, goes up and comes back. And so that's very, very common in this market right here. It's doing exactly what it should be doing. And so how am I trading it? I am trading my curvy mean reversion strategy so that I know if it keeps working, I'm very much convinced that we are in a neutral market regime. Now, if the mean reversion trading doesn't work, that's actually the market giving you a clue of what something different is happening. If this thing just takes off to the new highs from here, then that's telling you that, this was your great opportunity. And most likely this whole way up is going to be a really good place to keep adding to your positions. The market's telling you that it's not in the neutral market regime, it's in the bull quiet market regime. And so it's going to move higher. You get the opportunity to not be scared of buying it the whole way. Now, if the market turns and drops and continues into a 15, 20, 30% drawdown, well, it will tell us, the market will be telling us that we are in the bear quiet market regime by the price action. Mean reversion won't be working in that. It'll just be directional trading. Big rips up, bigger rips down. Of course, by that time, our SQN indicator will have flipped into the bear quiet market regimes. So my curvy 3.0 trading version of the system is what I trade S&P with on the day trading side. On the swing trading side, I use regular curvy 1.0. Currently, long gold, long copper, short silver, long gasoline, Bitcoin, NASDAQ, not long all those, but just in trades on all those. I originally built the system to help some of my traders that I work with pass prop tryouts. They're really into that. So it works excellent for day trading, especially keeping your risk management in check. But I absolutely love swing trading it personally. So I'm going to go ahead and put a link to the curvy system in the notes down below, which you're going to go get the indicator from too. This is the same system I've been running for multiple years. It's fantastic. Mean reversion is by far a huge edge to add to your trading. But the key point here is to know when to apply it. In what market regime do you apply it? What do you not worry about? What do you worry about? Nothing works in every environment, every market regime, every setup all the time. You have to constantly be adapting to different market conditions. All right, so that's it on the neutral market regime. If you got any questions, feel free to reach out on X, Twitter. I'm at Chris D Macro. If you're in the collective, DM me there. You can find me pretty much on Twitter most of the time. And don't forget to subscribe to the newsletter at macro-ops.com. We put out multiple articles per week, multiple emails per week covering where we are in market regimes, where we are in the market, what's going on the macro, on some of the value stuff. And that's where we go really, really deep. If you want to watch the videos on SQN, check that now.